Valued at roughly 87,000 crore rupees, Dixon Technologies operates as India's single largest electronics manufacturing services company. This chart shows the exact breakdown of their revenue verticals. Mobile phones and electronics manufacturing services dominate the book at 62%. Consumer electronics contribute 23%, home appliances add 7%, and lighting and security systems make up the final 8%. This workflow diagram illustrates two core business models, starting with the original equipment manufacturer, or OEM, division. Here, Dixon builds products precisely to an external brand specifications. The brand retains all intellectual property and pricing control, leaving Dixon with a very thin profit margin on the final assembly. In contrast, their original design manufacturer, or ODM division, handles the research, development, and design in-house before manufacturing the product. Because Dixon owns the design, they capture a larger share of the value chain and dictate higher profit margins from their clients. To scale these operations, the company has aligned its capacity with massive macroeconomic shifts. Policies like Make in India and global supply chains adopting China Plus One sourcing have drastically expanded their total addressable market. They are actively leveraging those macro tailwinds to expand horizontally. Beyond their traditional base in mobile phones and televisions, they are now securing contracts in high-growth sectors like IT hardware and telecom equipment. Their true economic moat is rooted in pure production scale, heavily amplified by the Indian government's Production-Linked Incentive, or PLI, scheme. The PLI scheme mathematically alters their unit economics. By receiving a 3 to 6% government payout on qualifying incremental sales, Dixon effectively subsidizes its manufacturing costs. This creates a pricing floor that regional competitors simply cannot match. Dixon's 87,000 crore market capitalization is built on the convergence of two specific factors: an aggressive manufacturing scale and the structural tailwinds of government policy. This bar chart outlines their staggering top-line growth trajectory over the past 3 years. Revenue jumped 66% in fiscal year 2022, 14% in 2023, and another 45% in 2024. As the top line expanded, absolute net profit followed the exact same trajectory. But as this flat line graph illustrates, that revenue growth masks a central paradox. Their EBITDA margin is stubbornly flat, hovering narrowly between 3.9 and 4.59%. To generate meaningful cash from a 4% margin, the business must intentionally process massive unit volumes. Profitability depends entirely on throughput. In their Q1 fiscal 2027 results, quarterly revenue spiked to a massive 15,500 crore rupees. Driven by that volume, net profit for the same quarter nearly tripled to 663 crore rupees. However, assessing these profit spikes requires looking closely at the underlying accounting. Take the third quarter of fiscal year 2026 as a forensic example. This chart breaks down the 68% profit surge reported in that quarter. Isolating the data reveals that 131 crore rupees of that total came from a one-time non-core gain, rather than an actual improvement in base manufacturing operations. When evaluating an electronics manufacturer, stripping out these non-core gains is critical to understanding the actual operational health and pricing power of the business. While rapid revenue growth can obscure structural margin limits, absolute profit remains strictly a function of their relentless volume expansion. This dashboard displays Dixon's elite return metrics. Return on capital employed hits 49.1%, and return on equity reaches 33.9%. The mathematical driver is extreme asset turnover. They cycle physical assets rapidly, so sheer capital velocity compensates for the low operating margin. Crucially, they have constructed this high-velocity system without relying on heavy external borrowing. Their debt-to-equity ratio is exactly 0.09. Remaining virtually debt-free shields the company from interest rate volatility as they expand their footprint. This valuation matrix shows how aggressively the market prices this efficiency. Dixon currently trades at a price-to-earnings ratio of between 70 and 92 times earnings. Furthermore, their price-to-book ratio sits at 25.16. The market is heavily discounting their future scale, granting Dixon a massive growth premium today. A return on assets metric of 17.9% validates this premium, proving their physical factory infrastructure is highly optimized for cash generation. When running these numbers, you will often see empty fields for GNPA, NNPA, and net interest margins. These stand for gross and net non-performing assets. They are banking-specific metrics used to measure loan defaults, completely irrelevant when evaluating a hardware manufacturer. The market is pricing Dixon as a high-velocity capital compounder, reflecting its ability to generate significant returns through pure operational speed. The operational engine allowing them to compound that capital without debt is a negative working capital cycle. This timeline equation breaks down their exact cycle. By adding their inventory holding days to their debtor days and subtracting their creditor days, we find that Dixon operates on a negative 8-day working capital timeline. In practical terms, this means Dixon collects cash from its buyers 8 days before it is required to pay its own component suppliers. When we compare their cash flow from operations to their profit after tax, the cash conversion is strong, proving the reported profits represent actual liquidity entering the business. This waterfall chart explains why their free cash flow appears volatile, despite strong operating cash. That cash is immediately drained by aggressive capital expenditure reinvestment to build out new facilities. This expansion model carries a primary operational risk: heavy customer concentration. Dixon relies on anchor clients like Motorola, Samsung, and Xiaomi for a massive portion of their volume. However, the sheer scale of this Tier 1 order book creates deep operational stickiness. It makes it incredibly difficult and expensive for those global brands to switch their assembly to a competing manufacturer. Pivoting to forensic accounting, we can check the integrity of the numbers management is reporting. This line graph shows auditor fees scaling proportionally in perfect tandem with revenue and profit after tax over the last 5 years. There are no unexplained spikes in auditing costs that typically signal accounting irregularities. By forcing its suppliers to effectively finance its inventory, Dixon has built a self-funding machine that scales rapidly without taking on destructive debt. This stacked area chart tracks institutional confidence in the model. The promoter holding is tightly locked in, remaining perfectly stable at 25.19, while foreign institutional investor holdings have slightly contracted to 17.8%. Consistent backing from domestic institutional investors at 8.3% keeps the capital base secure. Management is currently deploying an aggressive capital expenditure outlay, planning to spend between 1,100 and 1,150 crore rupees in fiscal year 2026 alone. This forward-looking roadmap shows exactly where that capital is flowing. The primary investments target the production of camera modules via their Q-Tech partnership, alongside heavy spending on display manufacturing and IT hardware. This is a textbook backward integration strategy. Instead of buying components from external suppliers, Dixon is moving upstream to manufacture the internal parts themselves. Bringing complex component manufacturing in-house is the primary lever management will use to permanently expand their baseline operating margins. The ultimate guidance for management is clear. Use this integration to elevate Dixon into the top 10 global electronics manufacturing companies within 5 years. Dixon is reinvesting short-term cash flow today to secure a vertically integrated dominant position within India's hardware supply chain tomorrow.